Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com. or text or call Andrew at 469-207-5844. That's 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Welcome. How is everybody doing out there today? Hope you are doing well. My name is Andrew Kuhn, the Focus Compounding Podcast. Geoff Gannon, how's it going?
It's going very well, Andrew. How's it going with you?
It is going great. We hope everybody is having a great week. This is the part 2 of our rapid fire questions that have been asked of us, and we're going to chat about them. If you do want to ask questions of us, feel free to either email info@focuscompounding.com, gannoninvesting@gmail.com, or follow me at FocusCompound on Twitter and tweet me. And a lot of times, like I said, I'll just put them on a spreadsheet or screenshot them, and then we'll just dedicate a full podcast to go over your questions. And it's great. So we're just going to roll right into it.
Okay.
We're going to roll right into it. Person actually asked about your latest memo about cloning super investors.
Okay.
And if you do want to get access to that memo, go to the website, Focus Compounding. That'll put you on our email list if you enter your email, and you'll get that from Geoff every single week. But he says in his latest memo, Geoff talks about cloning the super investors. I'm also interested in how to best execute a strategy on cloning. I've read that buying the highest conviction position of super investors are not a good strategy for good returns. He says, then he proceeds to say, let's see, the reason was that those positions are not the ones that have increased most in price since they bought them, and are probably not positions they think is the best value at the current price. Right. Maybe it would be the best to look at average buying price of the positions and use that for a buy or sell signal. Yeah,
that could be a good idea. So when I talked about the memo, is that, obviously one way you could do it is high conviction ideas, but the other way that you'd think about it is what are they buying most recently, right? So I think that probably the best way to do it is, as you just was suggesting that question, which is basically the highest conviction ideas are highest conviction buys are a good idea. So if you see a new 10% position as a new buy, that's a good idea. And using the average price at which they bought in. And there's lots of sites which give you average price information on it and percentage of the portfolio on it. So a high conviction idea at the time they bought it and a price close to when they bought it sounds like a good idea to me.
Yeah.
Right. I don't know that you'd want to buy something that they've owned for a really long time and that's gone up a lot, which is often the reason why something's really concentrated now.
Like they just have owned it and they've never sold it, so it's just become a huge part of their portfolio.
Right, which is like Sequoia with Valiant is what happened. So they had a big loss on Valiant eventually. But it's not like Valiant had this huge decline from where they originally bought it in the first place. It's that they never trimmed it back and it kept getting bigger and bigger. Yeah,
sure. And actually, Peter Rabb over Arco Capital, he talked about that and how there was a fund that he was at that kept it at, let's say, 7%. And every time it go like to 8 or 9% of the portfolio, they would just trim it back down to 7. So when the whole Valiant debacle actually happened, they didn't experience such a loss because over the years they made so much money from it.
Right. Yeah, exactly.
Thought that was interesting.
So high conviction buys are a good idea, I think, but you're right that usually when you see a huge holding at a company, that's because it's got at a portfolio, that's because that company has compounded, a lot, and they've owned it for a long time.
I'm gonna let you answer this one. He says, I wonder if there's a single download page where I can download earlier stock write-ups by Geoff for free on Singular Diligence. Where can they get all those?
If they become a member of Singular Diligence by paying, then they can find all the things that were there.
Yeah, and also if you do become a member at Focus Compounding, they're all on there. All the Singular Diligence write-ups that you did.
Yes, they are all there. And I forget how many there are, like 25 or something we said.
Yeah.
But they are not free. You have to become a paying member to get the access to that. Yeah.
Next person, do you consider the short interest of a stock in your analysis?
That's a very good question. Historically, yes, I had looked at it. It's something that I've always looked at. I haven't been able to find from research that academic research that it does what investors think it does as being a bad sign. And I have to say that also looking at my best performing and worst performing investments in the past, I did not find it to be true that it was a good indicator. So like some people had said, well, that stock that you bought, say like Weight Watchers or something, was heavily shorted. and then it went down a lot, and it was a big loss for you, and all that sort of thing, or even if it wasn't, it was a huge paper loss at one time, even if it came back somewhat over time. So the things, for instance, not just stocks that you lost money on, but stocks that at some point from the point you bought them to their lowest point were huge drops. Weren't those always stocks that were heavily shorted?
Yeah.
And in a lot of cases, there were stocks that were heavily shorted. The problem is that a lot of the big winners were also stocks that were heavily shorted. So I actually looked when I was doing singular diligence and did some sort of checkups on it as to what sort of things indicated risks and things. And the way I did it is not what people do a lot is they say, okay, well, I'll learn from my mistakes by sort of gathering up all the things that are that lost money and seeing what common traits they share, right? The problem with that is, instead of doing that, what I did is I separated into the top 20% of stocks that did well for me and the bottom 20%. And I looked at it from the perspective, well, what did the stocks that do badly have in common that they did not also share with the stocks that did well? And the problem is that there were characteristics I could find having to do with leverage and things like that. But basically leverage and basically leverage, both operating leverage and financial leverage. But what they did not, unfortunately, what was not specific to the stocks that did badly is the short interest. So yes, the stocks that did very badly had high short interest, but so did the stocks that did really well. That was also the thing for the two things that people ask a lot about are, should I avoid stocks with high short interest, and should I avoid stocks where people think that like the industry is going out of business or something, right? The problem is that in all the things that I looked back at my own decision making, that those categories are both the biggest losers and the biggest winners. See, if people short a stock a lot, like say Best Buy or something, people like short it a lot and think it's going to go out of business or something, and then it doesn't. Yeah, it actually recovers a lot and turns out to do really well, even if the business results aren't well. People forget that oh yeah, that was something that people thought was going to go out of business. It didn't. It was shorted a lot, and it turned out to be a really good decision that I bought it or whatever. If I had done that, whereas they do remember that. Okay, so that what happened to Barnes and Noble or whatever. So, short interest, I think you're likely to get really good or really bad results. The problem is that I haven't found it to be the case that that it can get really bad results. And also with academic research, I haven't really found good indications that of any research papers that have really said that they can prove that it's always an indicator for bad results. I think it will increase the volatility in your portfolio if you buy things that have high short interest, but I don't know that it'll help or hurt returns.
Got it. That's a great answer. Next question. How long of a track record do you need as an individual investor before you can say that you have alpha in the market?
There's no answer to that. I mean, there's just no answer to that. It really... if you ask academics, they'll tell you that Buffett doesn't.
Yeah, sure.
Some do. So we'll say that he does, but they will try to explain that he doesn't.
If you were to give your money to another manager,
right?
How long of what would you be focused on? Would it be their track record, their process,
not
the way they think?
Their process. Okay. Yeah, not their track record at all.
So you wouldn't think about, let's say, you literally wouldn't think about.
I would think about the track record, but not in the overall situation. I've talked about this a little bit before, but like there's someone who was talking to me about how great someone's record was over the last 8 years or something. But I saw what the stocks were. Yeah. And I would never trust them with my money.
Because they were all highly levered companies.
They were highly levered, and they were all levered to sort of one... No. They were all levered to sort of one macroeconomic idea, which they were right about, right? But so they were sort of right about a credit cycle or something, let's say, in that case. And so all their bets had to do with sort of the biggest leverage bets that you could make on the idea that you knew how the recovery in the economy would work and stuff. Basically, that you knew the economy would recover a lot, and interest rates would stay really low. Sure. So they were sort of right about the idea that interest rates stayed very low and unemployment was very low. If they'd been wrong about either one of those things, that interest rates went up a lot or that unemployment stayed high, then they wouldn't have been successful. So I think you need to look at the process of how they made the decisions, not just how they made the decision, but what sort of things they bought. Sure. So it depends. I've seen some investors who have really good results, but I wouldn't trust them. On the other hand, and then there are investors who I think have really good results, and I can look at how they got it. And while it's not my approach, I can understand that that they have added alpha and stuff, and that they have skill that way. I guess that's a real way of talking about it to me, is if they have skill that way. And so so like Monish is a good example of that, right? That's someone who has a totally different approach than I would ever have, but it's clear that that approach has worked over time, and you can see that in the results. But then there are other people that have good results for a while that I'm not sure, if you can explain it through things other than, if you want to say luck or something. I mean, that becomes difficult to explain differences between skill and luck and things like that. Yeah.
So I think this person is interested in, he's asking a lot of questions about being a do-it-yourself investor and sort of how to validate if this is like if it's working for him, I guess you could say. Because he asked another question saying, so then I also wonder how long of time you would give yourself as a do-it-yourself investor or stock picker versus indexing or handing your capital to a manager that you can trust.
Yeah, I would just do part index, part yourself, and as you gain confidence, switch it over. I mean, I think I mentioned once before that that's actually how I started as a teenager, is that I put all of my savings into an index fund. And then as I found stocks that I really was sure that I could value and that I believed in stuff, I then took money from the index fund and put it in that stock instead. I didn't hold cash. And then eventually, over a few years, I went from 100% in index to 100% in stocks that I picked myself. So I think it makes sense to do it with the stocks that you like yourself, rather than doing it from the perspective of like you have belief in yourself. I mean, this is a difficult one. This goes into all sorts of other things. It can be anything else. People always ask about this, about like want validation for basically that you have talent, right?
Sure.
So the same thing that you get this with people who are like starting out writing or something, and they're like, oh, it's really bad, and how do I know that I have talent or whatever, and things like that. And you want external validation for that sort of thing. And the unfortunate truth is you just have to keep doing it for a really long time, and you'll be bad at the beginning, and then you'll get better over time. Yeah.
And then the last question he asks is, which index should I compare myself with? Is the logic that if I only have U.S. large cap stocks, I should compare myself with S&P 500? And if I, for example, own only Swedish stocks, should I compare myself with the Swedish stock exchange and so on?
Yeah, I mean,
like a lot of people use S&P 500.
Yeah, I use the cheapest Vanguard one for the S&P 500 for our client letter.
So why did you do that instead of comparing it with like a small cap type?
Right, which you should theoretically do.
Yeah.
But it gets very complicated that way, because if you keep doing that, and I was talking about how like academics do this and stuff, if you keep doing that, eventually you don't compare Warren Buffett to an S&P 500 or something. You compare Warren Buffett to a low beta set of stocks, but he chose to do low beta. So that was one of the things that he chose to do. You know what I mean? Not that he sought out low beta, but that's something that he chose in terms of all the stocks that he has. So you can break it down into factors of saying, okay, so your actual stock picking, how much did that add? Same thing. I mean, in a sense, are you restricted that you can only own Swedish stocks, or are you choosing to invest in Sweden? I mean, for me, I can't find anything that can be an actual comparison normally. Because, like for my own portfolio in the past, I was willing to go anywhere. I mean, I invested 50% Japanese nets.
Yeah.
And historically, I've been 0% in Japanese.
Yeah.
And then a few years later, I was down to 0% in Japan again. So I had often been 100% US, and then I was 50%, and then when they went up, over 50% in Japanese stocks. And Japanese microcap stocks. At the same time, people would think that my strategy would change because I would own like, a bank or something, a big stock. I owned a couple big stocks, when mostly I own microcaps and things like that. So there's no direct comparison that way. I think the easiest way to do it is just over the long term compare yourself to probably the sort of the one that I use in the client letter is the Vanguard S&P 500 that had the lowest expense ratio that I could find. So basically just an actual fund of some sort instead of an index. Now they're basically almost the exact same thing, but you pick an actual fund and you say, well, people could have bought this. I mean, that's why the way I did it is, look, if you did nothing about how to pick a money manager or something, you could have just said, oh, well, I'll buy this because this is what you would think is right. I'd say the S&P 500 is the one that, maybe not, but I would say the people just in general, the general public would say, oh, that's the market.
Sure.
Right.
Yeah.
So if they said, I don't want to make any decisions, they just buy the S&P 500 every month, put in their savings into it and never touch it. Right.
Yeah, I would agree.
So that's the one that I would use. In terms of comparing it yourself, that gets incredibly complicated. Like, because at the end of, So, for instance, in the client letter thing, I compare it to the S&P 500. But if I actually compare to what investors are most similar to me, like blogs I read, investor letters I read, and things, a lot of them had horrible time in the last 6 months of last year. Yeah, way worse than the S&P 500.
Even a lot of like micro guys that I follow, they had a really tough.
Horrible. Yeah. But then in there are other years where if you had looked at the way that I looked at it in the early 2000s, I would have said, I did amazing against the S&P 500 in 2002, 2003. But if you looked at a lot of value people, they were doing very similar numbers to what I was doing, right? Mm-hmm. Because it was like a really good period for that. So in a sense, you can look at it and say, I understand that, a lot of the reason I did badly this year or something is because I own microcaps or whatever. So you can compare to other people who are similar to you. The danger with all of that is unless you have that one yardstick, then you can cherry pick either good or bad. If you're the sort of person who's kind of a depressive person, whatever, you always pick out the people who are doing better than you.
Sure.
And I've talked to people that way I've talked to people who beat the S&P 500 and complain about these people. How are these people doing better than me?
Yeah.
There's always someone who's doing a lot better than you. Yeah. Always. Yeah.
Yeah. That's really interesting. Probably not a good way to think about
it.
Let's see. Oh, this is interesting. Do you think it's possible to be a successful investor today without using the internet? Have you ever been asked that?
No, I've never been asked
that.
Maybe not.
I mean, because we use there's a lot of like scuttlebutt things you do with the internet, right?
I do a lot of scuttlebutt with the internet, and that's also how I get SEC filings.
Yeah. Okay, but let's say if you just could print the SEC filings, do you think that...
Well, I did in the early days of getting started investing. I should point out that I, from the very beginning, used the internet. Mm-hmm. I'm just young enough that when I started investing as a teenager, they had just started, I guess, had they just started Edgar? Maybe. So we're talking the later 1990s. Mm-hmm. So, but before the mid 1990s, everyone would have had to do it completely without the internet. Mm-hmm. Actually, Buffett talked about it in the interview that he did recently. He talked about how the internet's made it, the internet and other things, has made it much, much harder to outperform. The two reasons why it's hard for him to outperform is, one, the huge amount of assets that he has, but two, that he used to go to find out information about banks, insurers, all those things, railroad companies, whatever. He used to go in person to learn about it from some sort of library thing that was like a government paperwork and things that he could find. And you get that when you read about if you ever read like Ben Graham's memoirs or something, what he actually did to find cheap stocks and things is by going in person to request records and things. So yeah, I mean, it makes it harder. I would say, yeah, you probably need to use the internet today. Mm-hmm.
But you also, I think it's to your advantage, obviously. Like you could get a lot more information. You could scuttle. I mean, look, you're on, you always look at, Google Maps of like satellite images.
Absolutely.
And you could you get other information that probably would be a lot harder back in the day. Like even going to like Glassdoor and learning about the culture of the company, or if they've won any awards or, whatever.
Yeah, on the other hand, you can read the books by Ben Graham, Phil Fisher, early things about Warren Buffett and his biographies and stuff, and see how he did it. You could probably do the same things today.
Sure.
And they would work at least as well. I mean, one danger of the internet is that I do see is that people kind of expect that they can find information really quickly, and then if they don't find it, it's like not out there and stuff, instead of trying to really track it down. But you can use the internet in a very investigative way. So I think you probably need the internet today.
Cool. We got two more good questions. Okay. For the next 30 years, if you had to choose, would you rather hold the S&P 500 fund or Berkshire Hathaway, and why? For next 30 years.
S&P 500.
Really?
Because I don't know what's going to happen after Buffett and everything. Mm-hmm.
And you do know that you do feel strong about America's prospects and future over the next 30 years.
Enough. Yeah. And over 30 years, the starting price isn't that important at what you buy a stock. So the fact that I think the S&P 500 is a lot more expensive than Berkshire right now isn't necessarily a problem. So over 30 years, yeah. It just lowers the risk that you would have something go to zero or something. Obviously, it's just that Berkshire's a financial company. I don't know who will be running in the future. Mm-hmm. Those are the only reasons. Yeah.
And then he also asked, same person says, do you think it's a good idea to hold Berkshire or S&P 500 index instead of cash, so kind of what we were talking about earlier, when you have no more attractive stock picks, what about beginning with 100% of capital invested in Berkshire or an index and then allocate capital when you find a truly good stock pick?
Yes. That's
so would you rather use, I mean, let's say not over 30 years, but let's say over the next 5 or 10 years, would you rather do that with Berkshire or the S&P 500?
I think Berkshire's better than the S&P 500. We'll see if it outperforms something over the next 10 years, but I think it's a better value. For someone just asking the question now in terms of like, say the person asking is not me. So I would say, 50% in the S&P 500, 50% in Berkshire, and then each time you find a new stock, let's say your goal is that you want your 10 favorite stocks.
Yeah.
Okay, then take 5% from each time you buy a new stock. And do it that way. And then eventually you'll get rid of Berkshire and you'll get rid of the S&P 500. I should say, I mean, Berkshire is not the best stock out there. It's a huge stock. It's very hard for it to get really great returns in the long run. The S&P 500 is expensive, and it's very hard for it to it can't outperform itself. But I mean, for it to even perform above single digits for the future, right? So it'd be very hard for it to achieve 10% or better for a long time in the future. There are stocks you can find that will do that. So, I'd say put half your portfolio in Berkshire, half your portfolio in S&P 500, and then gradually take it down to find 10 stocks probably.
What made you do that back in your early days?
Because I didn't know anything about investing. So until I got very comfortable with a company, I didn't want to put any of my money in it. You just diversify. I mean, it's like Buffett says, you diversify when you diversify away ignorance, when you don't know things.
Yeah.
If you know things, you don't need to diversify. So at first I didn't know anything. So you diversify across everything. And then what you do is, as you feel that you know a company really, really well, then you buy that. So, like as an example, I would get to the point where I decided in the 90s that like J&J Snack Foods, which is a very simple company, is something that I understood well enough that I would be more comfortable owning that than I would this set of businesses, the S&P 500, which I don't really know about.
Sure.
So at that point, then you move into owning that, or Village Supermarket, or Activision, or any of those things that I bought then. So yeah, I mean, mostly it's just things that you're really, really comfortable in. And so you compare it to being diversified. If you would feel more comfortable being diversified with all that money than having it in the stock, then you don't understand that stock well enough. You're not confident enough about that stock. You shouldn't own it. If you think that moving money from the diversified thing into that stock is somehow increasing your risk, then that's a mistake. You don't understand that business well enough.
Then you shouldn't do
so it should feel comfortable that way. Now, the problem with cash, there are a lot of reasons why I don't like the idea of holding a lot of cash. I think all the big mistakes that I would make would be when I have cash, basically. And then I certainly think that that's true with Buffett.
Is it because you feel like a almost like pressure to redeploy it as fast as possible?
Yeah. And especially now that I'm have clients with that where they can see that they have, a certain percentage in cash or something. Sure, of course, you feel they don't want to be paying you money to hold things in cash and stuff. Yeah. So, and that's why professional, and that's why institutions and things hold almost, no cash, or probably pay too much for things and stuff like that because they don't feel comfortable enough holding cash. Yeah. It's a good thing to feel comfortable holding cash until you decide to be 100% in something. I don't like the idea of holding cash all the time. But yeah, it would be good if you could feel that holding cash isn't wasteful in some way. I mean, it is wasteful, but if you were willing to be patient enough to sit there and not buy anything for a year or something. But I've sat with 30 to 50% cash for over a year at times. So
cool. Well, that was a great rapid fire question. So I want to thank everybody who participated in that, and whether they sent in an email or DM or just tweeted at me. If you do want to do that, like I said at the beginning of the show, feel free, and we will sort of aggregate them and then chat about them on the show. You could DM me, tweet me, or email me at info@focusedcompounding.com or Geoff@GannonOnInvesting.com. If you want to get access to Jeff's memos that we send out, there's two. There's a premium memo and there is a free memo. Premium is for whoever becomes a member, and then the free obviously is you just enter in your email.
The premium is a watch list. Yeah. So
yeah.
You get a list of what stocks I plan to write up in the future.
Yes. And you could follow along from that. Go to focusedcompounding.com, and for the free part, just enter in your email. The premium watch list, become a member, use the podcast promo code if you like saving money, which is podcast, and that's it. Other than that, thank you so much to everybody for listening. If you do like the work that we're doing here, feel free to go and give us a rating and review on iTunes. That helps us out a lot, and it sort of spreads the word.
Yep.
And we will like that. So thank you to everybody. Have a great week. We will see you in the next one. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. If you want to know more about specific stocks I like, go to focuscompounding.com, where you can read stock ideas written up by me and other members. Membership costs $60 a month, but if you use the promo code podcast, it'll be $50 a month for you. Andrew and I also manage accounts for investors. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. That's 469-207-5844. Thanks for listening.